In a few minutes, we will discuss a number of definitions about the commercial terms, with the goal of understanding the concepts of accounting, rules and standards to be able to react with accounting environment and to be able to win an accounting certificate. In a simplified way, accounting is a language of business. Unless you can understand accounting, you will not understand business. But it is a very special and living language with its own terms that allow describing any business activity. For example, you can use the word of equity instead of mine, and another example, liquidity instead of money. Assets present the economic resources controlled by the entity. Examples: liquidity, cash, inventories, and receivables. Liabilities are the obligation of the entity to transfer an economic resource. Examples: payable, short-term financial liabilities, deferred income. And what's equity? Equity is the net assets of the enterprise, that is, the assets of the enterprise minus its liabilities. Also, equity is the residual interest in the entity's assets, deducting all of its liabilities. Also, equity is the remaining ownership in an entity's asset that cover all its liabilities. Example: issued capital, capital received. So, what is the income? What about income? Income is an increase in assets or decrease in liabilities that resulting in the increase in equity. Examples: issued capital and capital receivers. The expenses. It is a decrease in assets or an increase in liabilities that resulting in the decrease in equity. Another point: who are the user of the accounting information and what are their needs? The primary user of the accounting information is the business itself. Users are finance directors, marketing managers, and production supervisors, and their needs are past and prospective data for strategic and operational planning, for decision making, and for management control. Managers are named internal user of accounting information. Financial accounting is concerned with the identification, capture, record, process, and presentation of economic events, nature and the purposes of accounting standards. User of financial statements need to understand financial information in the same way. Accordingly, financial accounting is based on a set of rules and standards. Financial statements are the final output of accounting process. The accounting process consists of structured multi-set progressive classification and aggregation process of the elemental data. What are the components of the financial statements? Balance sheet, profit or loss statement, statement of cash flows, and statement of changes in equity. The balance sheet reports on company's financial position at a point of time. Assets, liabilities, and equity are the elements of the balance sheet, which shows the accounting equation or balance sheet equation. The break-even point tells us the value and quantity of sales, resulting in zero operating income. Break-even quantity of units equal fixed costs by selling price minus variable cost unit. Break-even sales revenues equal break-even quantity of units multiply selling price. Income statement. All income statements adhere to the following basic. Revenue minus cost of goods sold, resulting gross profit, minus general and administrative expenses, other income minus other expenses, equal income before taxes, income taxes, we obtain net income. Introduction to the concept of working capital. The concept of working capital originally guarantees the fulfillment of the obligation in the event of liquidation, and the company owns short-term assets, and these assets are insufficient to meet short-term debts.